Hey, it's Cal Ewing coming at you from sunny Calgary. We're in mid-March and we got a pretty pleasant sunny day. We've had a bit of cold weather in the last while, so I think spring's finally on its way here. So today's video, I'm going to direct this out to potential investors that are wanting to act as funding partners on some of our mortgage note deals, as well as anyone out there that's looking into investing in real estate or investing in mortgage notes. And you want to get an understanding of what some of the potential risks are of investing in notes. And a lot of the things I'm going to talk about today also apply to just investing in real estate in general. So I'm going to go through the top 9 things that you need to be aware of. These are the top 9 risks that I was able to come up with when investing in mortgage notes, and some of the mitigation that we do to protect ourselves and our funding partners from these risks. Number one is the question that always gets asked first is, what happens when we buy a mortgage note and we've got a borrower, either they're paying already or they're a non-performing note, and we're going to hopefully get them paying again on the note. But what happens if either the borrower never ends up getting back on track and paying again, or what happens if our paying borrower suddenly stops paying us as the bank or the mortgage holder? And so this one is pretty easy. Because we buy the note and we also have the deed of trust or the mortgage assigned to us, this means that we have, as the lender or as the note holder, we have the collateral of the house that we can foreclose on in order to get paid back if the borrower stops performing and stops paying as per the directions in the note. We have the ability to commence foreclosure because we are now the bank, and we have the rights, like any other bank does, to foreclose on a property if the borrower stops paying. Okay, so what we typically would do is follow the rules in that state, hire an attorney that specializes in foreclosures in that particular state where the property is, and we go through the foreclosure process. Okay, so that one's pretty easy. But the next question is, well, what happens then if the borrower were to drag out the foreclosure over a long period of time? And in some ways, there's nothing we can do to stop that at every time. But what we try to do to mitigate the risk of that is we avoid the long foreclosure states. And these are typically states like New York and New Jersey, where the foreclosures can take sometimes up to 3 years. And we also avoid states where there's a long eviction process, where, maybe we can foreclose, but we can't get them out of the house, okay, if we take the property back. So personally, I avoid New York and New Jersey. Those are my main two. Chicago, the county, is it Cook County, Chicago? Places where it's going to take a heck of a long time to foreclose if we have to, all right? The other thing is sometimes if we avoid the higher end properties, so I like to stick buying notes where the property value is $250,000 or less. Sometimes when you get up into the very expensive properties, these people obviously can afford to buy an expensive property. They can probably afford to pay an attorney to prolong the foreclosure and stretch it out a very long time. So that's one of the reasons why I like to buy notes where the property value is $250,000 or less, is because typically these are more entry-level property owners, and if they can't afford to pay their mortgage payments, they probably can't afford to pay an attorney to drag the process out a long time. Okay, the next question is, well, what happens if we start foreclosure and the borrower gets mad and destroys the property? So this is something that, again, you can't 100% stop, but we always have insurance on the property, number one. So we are added as a loss payee or as a lender on the insurance policy when we buy the note. Okay, we make sure that we are added on there as a payee so that if anything happens to the property, as the lender, we get paid first. Okay, so that's one thing. The other thing we try to do, if we have to foreclose and the borrower is still living in the property, we try to approach them in a friendly way. I mean, a few times trying to get them back on track, trying to help them. But also, if we are at a point where it looks like we're going to have to foreclose, we offer a deed in lieu of foreclosure, or also known kind of as a cash for keys situation. So we offer to say, look, Mr. or Mrs. Borrower, this obviously isn't working out, but we can save you from having a foreclosure on your record if we can do a cash for keys scenario where you just deed us the property. We can forgive the foreclosure. We won't have it on your record. And then in exchange for you giving us the keys and the deed to the property, we'll pay you a certain amount of money to handle your moving costs and vacate the property in good condition. So in its current condition that it's in right now, before we give you the money. So that we would look at the property at that time, and then when they vacate, if the property is still in that same condition, then we would give them their money that we agreed to give them. And if they were to destroy it, then we wouldn't. So that's another way we can mitigate that a little bit. All right, so the next one is an act of God, or a flood, the house burns down, a tornado, something like that, where the property gets damaged. And so this is again where we make sure, as the note holder, we have our company and our investor. If we're using an investor to fund the deal, we make sure that they are listed as either a lender or a loss payee on the homeowner's insurance policy. And even if it's a flood zone or something like that, a coastal property, we may also make sure that there's a flood insurance policy on that property, just in case something were to happen. Then we would get paid out for the damages to the property. And this actually happened to me. When I was flipping houses, we had a hurricane hit one of our properties that we were rehabbing, and our hard money lender that we had on the loan deal, or on the fix and flip, they were listed as a loss payee. And so when the insurance money came in, the insurance money actually went to the note holder or the lender, and then they dished it out to my company to complete the repairs after the flood. So it would be the same situation when we're the bank and we own the note. Okay. Another one is, well, what happens if over the course of owning the note, the value of the property drops? And we have seen this a little bit just in 2023 compared to what property values were in 2022. So one of the things we do is we always try and buy notes at a discount, and also the amount that we invest into the note to buy it, we want to make sure that the loan, or our investment to value, so our investment, the amount we pay for the loan compared to the value of the asset or the property, we want to make sure we have at least 20 to 30% equity. So that way, if property values do drop some, we still have that equity protection there, so that we wouldn't lose money if the property values were to decline over time. Okay. If it's a non-performing note, we try to be even lower. We try to be buying the note at 50 cents on the dollar, 60 cents on the dollar, something like that, where there's a lot more protection should values drop. We're going to have a big cushion in the unlikely chance that we have a big decline in that real estate market in terms of property values. So when you think about it, a 30% decrease in market value is pretty tough to achieve. It's not impossible, but you'd have to have a pretty big, economic disaster to have that kind of a decline in property values. So we feel that buying at 70 cents on the dollar is a pretty safe equity cushion for us. The other thing is we actually watch market conditions, right? So if we own a note and we're seeing a major decline in a certain market where we own the note, I'm watching that, and I want to make sure that if I have to dump that property and sell the note before we get a major collapse in that market, we're going to try and be on top of that ahead of time, sell off the note and get paid back before something like that were to happen. All right, the next one is, well, what happens if we buy a note, we own it for a long time, and then the borrower ends up paying more than we owe our private investor? So a lot of times when I buy a note, I use a private investor to fund the deal. And so in order to make sure that we don't own that note so long that the borrower pays down the principal value of the note below what we owe our investor, we look at an amortization schedule for that note, and we mark it before we even buy the note and bring on an investing partner to fund the deal. We look at what date that borrower is going to pay down the principal of the loan, so that it's hard to explain. I'll give you an example with numbers. So let's say we buy a note for $50,000 and we borrow that $50,000 from our funding partner. Well, we're going to look at the loan amortization schedule, and we're going to circle the date where the borrower has paid, just a little bit above $50,000, or has a little bit above $50,000 remaining on that loan. And at that point, we're going to make sure that we either sell that note before we get to that point, or pay out our investor so that when so that basically we don't run out of money to pay our investor back, because we pay our investors interest only. We don't pay down the investment amount. And so we want to make sure that if our borrower sells the property or refinances, the proceeds of the sale, when they pay us off, the principal balance is going to be high enough to pay our investor back with no problems. And so we always look for that date where the loan amount's going to be below what we owe our investor, and we make sure we get out of the deal before then. Hope that made sense. It was hard to explain that one. Okay, next one is title issues. So sometimes, you have an old property that changes hands over many times during the life of the property. Sometimes there could be title issues. Sometimes title companies miss transfers of ownership. If you've got deceased owners and it gets passed on from one heir to the next, over time, the chain of title, there could be issues that could haunt future lenders like us or note buyers, but also future property owners. And so we either look to make sure that there's a title policy on the property recently that the current borrower had when they acquired the property. We may even get a lender's title insurance policy on it, or we're going to do no matter what, we do a full title search on the property before we buy the note to make sure that there's no issues in the chain of title that could come back and haunt us and affect our investment, or even maybe have us lose our investment. So we want to make sure there's no title issues on the property. We also want to look at the chain of transfer of the note, so the chain of assignment of the collateral, to make sure that there wasn't any issues in the assignment history of that note. So when it gets passed from one bank or lender to the next, we want to look at all of the history of how that bank or how that note was assigned from one bank or one lender to the next, to make sure there's no issues there, any errors on the assignment of mortgage that could affect us and make it so that we actually don't own the note. Okay, so we want to make sure there's just no issues or defects in title before we close. The second last one, number 8, is taxes. So when you're buying first position notes like we are, first lien mortgages, there's not much that can take us out. We're in first position, which is a good place to be. So that means that we get paid first as the first lien mortgage holder. But there is one entity that can wipe us out and have priority over us, and that is unpaid property taxes. So, and I think almost every state, if the borrower does not pay the property taxes to the county has the legal right to foreclose and basically wipe out the lender or any other lien holders. They have priority to get paid first before any other lien holders. Okay, so that's the one real risk that we have to worry about as a note buyer, is if we're buying the first lien note, is we just want to make sure that the property taxes are always paid so that the county can't sell it out from under us and we could lose our investment or lose our investors' capital. So before we buy the note, we want to always do a tax search to make sure property taxes are current. And if they're not, then we fade our bid or lower our offer price by the amount of unpaid taxes. And then when we buy the note, we do pay the taxes and get it caught up. Then we have our servicing company typically set up an escrow collection. So they are going to be taking in a monthly payment to go towards the annual property taxes from our borrower. Okay, so let's say the taxes are $1,000 a year. They'd be collecting 1/12 of that every month from the borrower's payment, so that when tax time comes, our servicing company has already collected that amount for taxes, and then they pay the taxes and keep them current. Okay. So that's one thing we always stay on top of, is making sure that the taxes go paid. All right, and then the last one is just unknown risks, right? So we've all lived through the COVID pandemic. No one saw that coming. People lost their jobs. Foreclosures were stopped. There's all kinds of things that were affected. County offices were closed. Everything ground was ground to a halt, and people couldn't do anything, right? People weren't getting paid. Landlords weren't getting paid. Lenders weren't getting paid. And those kind of things, what can you do, right? You just don't see them coming. Even back in 2010, the state of Nevada put a halt on all foreclosures because there were so many, and there was, I don't know how to explain it. They were just faulty foreclosures. There were so many of them that sometimes they were wrongfully foreclosing in the state of Nevada. And so the government put a halt on all foreclosures for a while. And so lenders were unable to foreclose for a time. Again, that's something, if you're a lender in Nevada at that time, what can you do, right? So one thing we do to mitigate the unknown risks are to diversify. So I like to buy in more than one state when I'm buying notes. That way, if we have notes in multiple states, the chances of it, affecting every single state are lower, right? So that's one thing. The other thing is we diversify the number of notes we buy. So if we had $1 million that we could buy notes with, instead of buying $1 million note, all the risk is on that one borrower and that one property and on that one note. Instead, we'd rather spread that $1 million out and buy numerous small notes on different borrowers, different properties in different states. To that way we can spread our risk out over multiple assets and reducing the risk of something bad happening. Okay. So that's about it. There's 9 things right there. The borrower stops paying, the borrower drags out the foreclosure, borrower destroys the property, acts of God like flood and fire, market values dropping, borrower paying more than we owe our investor, or paying down the loan before, like lower than what we owe our investor. I don't know why I have such a tricky time with that one. Title issues, unpaid taxes, and unknown risks. So those are all the main risks I could think of when it comes to investing in notes, as well as most of these apply to just investing in real estate in general. So I hope that helps kind of ease some of your fears, or at least allows you to know the right questions to ask or consider when you're buying a property or investing in a note, or maybe funding someone else's note deal or property deal. These are all the risks you need to think of, and make sure that you've got all of these handled in your due diligence or in your just normal business processes before you do anything, before you fund any deals and put your money at risk. You want to think of all these things. All right, so I hope that was useful to everyone. If you have any questions or comments, feel free to post them below. Feel free also to subscribe to my channel. I try to put out content every week on real estate and note investing. And if you are interested in getting involved in some of our note deals, we're always looking for funding partners to do more deals with. So you can reach out to me and schedule a call, and we can talk real estate by going to talkwithcalewing.com. There's also going to be a link somewhere associated with this video that you can click on. It'll take you to my calendar page. You can book a time and we can chat, talk about real estate. All right, I'm Cal Ewing. We'll see you on the next video.